I want you to think about the last time you checked your bank account and felt genuinely good about what you saw. Not relieved, not neutral, actually good. For most people reading that sentence, they're struggling to remember a specific moment. Maybe there was a brief window after a paycheck landed, maybe right before rent was due. But that feeling, the calm, steady confidence of someone who knows their finances are working, is something most people have never actually experienced for more than a few days at a time. Here's the number that explains why. According to the Federal Reserve's most recent data, 37% of Americans cannot cover a $400 emergency expense without borrowing money or selling something. Not $4,000, not $40,000. $400. That's one car repair, one unexpected medical copay, one appliance breaking on an inconvenient Tuesday, and more than 1 in 3 working adults in the wealthiest country in human history cannot handle it without going into debt. But here's what makes that number genuinely disturbing, and what most coverage of that statistic completely misses. This isn't a problem concentrated among low-wage workers or people without education. The researchers found this financial fragility across income levels, across college degrees, across what looks, from the outside, like perfectly stable middle-class lives. The person earning $95,000 and the person earning $35,000 are often in functionally identical positions. One paycheck away from a problem, with nothing built up, nothing compounding, nothing working in their favor while they sleep. And the reason isn't income. The reason is behavior. Specifically, 11 behaviors that quietly drain financial progress regardless of how much money comes in. Behaviors so normalized by the culture around us that most people engage in them daily without ever recognizing them as the source of their financial smoothie. Stagnation. I'm Daniel. Today we're going through all 11. Not to make you feel bad about where you are, but to show you exactly what's happening, exactly why it's happening, and exactly what changes when you stop. Let's go. Reason 1. You're moving without a destination. Here's a question most people have never actually answered. Where, specifically, are you trying to go financially? Not generally, not vaguely, specifically. What is the number in your investment account that would make you feel genuinely secure? What is the debt balance you're working to reach zero? What is the date by which you want to own a home, or retire, or have 6 months of expenses saved? Most people don't have answers to these questions. They have feelings. They want to be better with money. They want to save more. They want to feel less stressed. But feelings aren't destinations. And without a destination, every financial decision gets made in a vacuum. Should you buy the thing or save the money? Should you take the overtime or protect your weekends? Should you pay down debt or invest the extra? Without a clear target, these questions have no right answer. So people guess. And the guesses tend to favor whatever feels good in the immediate moment, because there's no future goal specific enough to make the trade-off feel real. The fix is almost embarrassingly simple. Write down a specific financial goal with a specific number and a specific date. Not save more money. Save $8,000 in an emergency fund by March of next year. Not pay off debt. Pay off the $4,200 credit card balance by August. When the destination is specific, the decisions that lead there become obvious, and the decisions that lead away from it become visible in a way they never were before. Reason 2. You're treating surprises like surprises. The average car in America is 12.6 years old. The average home appliance lasts 10 to 15 years. The human body requires medical care with increasing frequency as it ages. None of this is surprising. None of it is unpredictable. And yet, when the car breaks down, when the water heater fails, when the medical bill arrives, most people experience it as a financial emergency rather than a normal event they'd prepared for. This is the emergency fund problem. And it's not actually about having $400 available. It's about understanding that unexpected expenses are not unexpected, they are inevitable, they are regular, And the only real question is whether you've set aside money in advance to handle them without disrupting everything else. Without an emergency fund, a single inconvenient event triggers a chain reaction. The repair goes on the credit card. The credit card balance increases the minimum payment. The higher minimum payment leaves less money available for everything else. The financial margin that never quite existed gets thinner. The stress level increases. The next inconvenient event hits a financial system that's already compromised. With an emergency fund, even a modest one, 3 months of essential expenses sitting in a separate account, that same car repair is Tuesday. It costs money, it gets handled. Life continues without a ripple. Building the emergency fund before anything else, before investing, before aggressive debt payoff, before any other financial goal, is the foundation that makes everything else possible. Reason 3. You don't know where your money goes. Here is one of the most reliable financial experiments you can run on yourself. Before you read the next paragraph, estimate how much you spent last month on food, restaurants, takeout, coffee, grocery store runs combined. Write that number down. Now imagine checking your actual bank and credit card statements and adding up every transaction in that category. For the overwhelming majority of people who run this experiment, the actual number is 40 to 80% higher than the estimate. Not because they're lying to themselves intentionally, because spending happens in small increments that feel insignificant in isolation and add up to something significant in aggregate. The $12 lunch that doesn't feel like a decision. The $6 coffee that's just part of the morning. The $8 delivery fee that comes with the convenience of not cooking. None of these feel like wealth-destroying choices. Collectively, they frequently represent $400 to $600 per month in a category most people would estimate at $200 to $250. Tracking spending isn't about restriction, it's about awareness. You cannot make intelligent decisions about money you haven't measured, and most people are operating entirely on feel, which systematically underestimates spending and overestimates the money available for saving and investing. Track every dollar for 1 month. The category that surprises you most is where your financial leverage is hiding. Reason 4. Your future self doesn't exist to you. Behavioral economists have studied a phenomenon they call present bias, the deeply human tendency to overweight immediate rewards relative to future ones. In plain language, the version of you that exists right now feels real. The version of you that exists at 65, navigating retirement on whatever you've accumulated, feels abstract. And the brain treats abstract futures as less important and concrete presence in virtually every decision it makes. This isn't a character flaw, it's neurology. The brain's reward system responds to immediate gratification in a way it simply doesn't respond to delayed gratification, even when the delayed reward is objectively larger. But here's what present bias costs in specific calculable dollars. The 25-year-old who delays investing for 10 years, who chooses the immediate consumption over the future account and starts at 35 instead, ends up with approximately $200,000 less at retirement. Not because they saved less total, because the 10 years of compound growth on the early contributions never happened. Your future self is a real person. They will have real bills, real health concerns, real needs, and real regrets about what your current self chose to prioritize. The most effective way to take that person seriously is to automate transfers to their account before you have a chance to decide in favor of the present. Reason 5. Your habits are spending your retirement. Nobody sits down and decides to sacrifice their financial future for daily convenience. It happens incrementally, in amounts small enough that each individual decision feels reasonable. But let's run the actual numbers on some of the most common ones. Daily coffee shop visits, $6 per day, 5 days a week, 50 weeks a year. Annual cost, $1,500. Invested for 30 years at 7%, approximately $151,000. Daily lunch out instead of bringing food, $12 average, 5 days a week. Annual cost, $3,120. Invested for 30 years at 7%, approximately $314,000. A pack-a-day smoking habit, approximately $3,000 annually at current prices. Invested for 30 years at 7%, approximately $302,000. Forgotten subscription services. The average American household pays for 4.5 subscription services they either rarely use or have completely forgotten about. Average cost, approximately $85 per month. Annual, $1,020. Invested for 30 years, approximately $1,000 and $3,000. These aren't arguments that you should live without pleasure or convenience. They're arguments that these choices have a specific long-term cost that most people have never actually calculated, and that seeing that cost changes the decision in a way that vague advice about cutting back never does. The coffee is not the problem. The coffee plus the lunch, plus the subscriptions, plus the smoking, plus the impulse purchases, all in the same budget, all in the same month, all without any of them being measured, is the problem. Reason 6. You don't know the difference between debt that builds and debt that destroys. Not all debt is equal. Treating it as if it is costs people enormous amounts of money over their lifetimes. Here's the distinction that matters. Debt that builds wealth finances assets that either appreciate in value or generate income. A mortgage on a primary residence in a growing market, a student loan for a degree that meaningfully increases earning power. A business loan that funds profitable operations. These forms of debt put money to work in ways that, over time, produce more value than they cost. Debt that destroys wealth finances consumption. Credit card debt for things that are gone by the time the bill arrives. Auto loans for vehicles beyond what transportation actually requires. Buy now, pay later financing for electronics, furniture, clothing, and experiences. These forms of debt charge interest on assets that are either depreciating rapidly or already consumed entirely. Here's why the second category is particularly devastating. 21.6% average annual interest rate on a credit card balance means your debt is growing faster than almost any investment can grow. A $5,000 balance paid at minimums doesn't just cost $5,000. It costs more than $11,000 over the life of repayment. And every dollar paying that interest is a dollar not compounding in an investment account. The single most impactful financial move for anyone carrying high-interest consumer debt is not to invest more aggressively. It's to eliminate the debt that's compounding against them at a rate no investment can beat. Reason 7. You're spending money to look like you have money. There's a specific financial trap that's most visible in the gap between how people appear financially and how they actually are financially. The leased luxury SUV. The secret of residence and consent is not. The designer clothes on a credit card, the expensive apartment in the prestigious neighborhood, the upgraded phone on a payment plan, the restaurant that costs $80 per person for occasions that used to cost $20. None of these purchases are driven primarily by utility. They're driven by the signal they send, the impression they create for colleagues, neighbors, friends, and sometimes strangers who will never interact with the purchaser again. This is sometimes called the Veblen trap, consuming visibly to signal status, even at the direct expense of actual financial security. Here's the irony that makes it particularly expensive. The people most likely to be impressed by these signals are also the people most likely to be making the same financially destructive choices for the same reasons. The colleagues admiring the luxury SUV are often making their own status-driven purchases. The wealthy people whose approval is being sought, the people who have actually built financial security, are overwhelmingly not impressed by these signals. They're too busy running their own finances too carefully to care about yours. The research on this is consistent. Genuinely wealthy people spend less conspicuously than people who want to appear wealthy. The neighbor driving the 10-year-old sensible car might be worth more than the neighbor in the leased German SUV. Appearances in personal finance are almost entirely deceiving. Before any major purchase, the honest question is, am I buying this because it solves a genuine problem? or because of what I imagine it communicates about me. Reason 8. You pay everyone else before you pay yourself. Here is the most common financial sequencing mistake in America. Paycheck arrives, rent gets paid, car payment gets made, utilities get handled, groceries get bought, subscriptions get charged, various other expenses get covered. If anything is left, which there frequently isn't, some of it might go to savings. This sequence sounds responsible. It feels like taking care of obligations first. It is, in practice, a system that guarantees wealth building never becomes a priority, because there is reliably nothing left when it reaches the back of the line. The alternative is not complicated. It is simply a different sequence. Paycheck arrives, a fixed, predetermined percentage goes immediately to investment accounts, before rent, before groceries, before anything else. It moves automatically, on payday, without a monthly decision being made. What remains gets allocated to everything else. This forces adaptation. It compresses the available spending money in a way that most people find uncomfortable for about 3 months and then normalize completely. And it ensures that wealth building is not an afterthought, it is the first obligation, treated with the same non-negotiability as rent. The people who build real wealth on ordinary incomes almost universally use this system. Not because they're more disciplined than everyone else, because they've designed a system that doesn't require discipline in the moment. It happens automatically before the moment arrives. Reason 9. You're avoiding risk instead of managing it. There is a version of financial caution that is genuinely prudent. And there is a version of financial caution that is itself a form of financial risk, one that most people never recognize as such. The person keeping $40,000 in a savings account earning 0.5%, while inflation runs at 3%, is not being safe. They are losing purchasing power at 2.5% annually, slowly and invisibly, without ever experiencing the sharp feeling of a market loss that would make the risk feel real. The person who avoids the stock market entirely because it might go down, while watching the same money lose value to inflation year after year, is not avoiding risk. They are choosing the risk of certain slow loss over the risk of volatile potential gain. Intelligent risk, time and time again, is a risk of losing less in wage. It's understanding what you're exposed to in every scenario, including the scenario where you do nothing, and making informed decisions about which risks are worth taking. Broad, diversified, low-cost index funds have returned an average of approximately 10% annually over the last century. Through every recession, market crash, war, and economic disruption in that period. The risk of being in them is real. The risk of being out of them over a 30-year investing horizon is arguably larger, because the certain outcome of staying out is that you accumulate nothing. Reason 10. Your income has only one source. Here is the mathematical ceiling that limits most people's financial progress without them ever explicitly acknowledging it. There are 168 hours in a week. Most full-time jobs consume approximately 40 to 50 of them. There is a hard physical limit to how many additional hours can be worked. And trading time for money, even at a high hourly rate, has a ceiling that no amount of overtime can break through. Wealthy people don't primarily earn more per hour. They earn from more sources that don't require their active time to generate income. Rental income from a property they owned, dividend income from investments, revenue from a business that runs without their constant involvement, royalties from content, intellectual property, or creative work created once and generating returns indefinitely. Building these streams takes time, initial capital, and often a period of reduced present consumption to fund the investment. This is why most people don't do it. The cost is immediate and visible, while the benefit is delayed and uncertain. But the math is unavoidable. Single-income households are one layoff, one health crisis, one company restructuring away from financial catastrophe. Multiple income streams create resilience that no level of savings in a single source arrangement can replicate. The path to a second income stream doesn't require quitting your job. It requires identifying something you can monetize, a skill, a service, a content format, an asset, and building it in the hours that aren't already claimed. Reason 11. You stopped learning about money. The financial landscape changes. Tax laws change. Investment vehicles evolve. Economic conditions shift. New opportunities emerge, and old strategies stop working. The person who learned basic money management principles 20 years ago and hasn't meaningfully updated their financial knowledge since then is making decisions based on a world that no longer fully exists. They might be missing vehicles like Roth conversions that didn't exist in their original financial education. They might be paying fees for actively managed funds that decades of data have shown to underperform index alternatives. They might be making tax decisions that cost them thousands of dollars annually in ways a few hours of current reading would have prevented. Financial literacy is not a destination. It is a practice, something that requires ongoing attention in the same way that professional skills require ongoing development. The barrier to entry has never been lower. Books, podcasts, YouTube channels, and reputable financial websites provide more high-quality financial education than was available to most people a generation ago, most of it free. Most of it accessible in the hours of commuting or exercise that most people are already filling with something. The people who continue building wealth over decades are almost universally people who continue building their understanding of how money works. Not because financial genius is required, the core principles fit on a single page, but because the world keeps changing and staying current keeps you from making expensive, outdated decisions. What you do with this, here's the honest summary of everything we've covered. 11 behaviors, all of them normalized by the culture around you, all of them practiced daily by the majority of people you know. All of them quietly, reliably, systematically working against every financial goal you have, regardless of how much you earn. None of them require a difficult life to fix. They require awareness first, then specific changes to specific systems. Pick one, not all 11. One, the one that you recognized most clearly in your own life. The one where the gap between what you're doing and what you should be doing is most obvious. Change that one thing this week. Make it automatic where possible. Remove the decision from your daily willpower budget and build it into a system that runs without you. Then pick another. The people who build genuine financial security over their lifetimes are not exceptional. They are not luckier, smarter, or more disciplined than everyone else in any inherent way. They simply identified the behaviors that were working against them and replaced them one at a time with behaviors that worked for them instead. The process is not dramatic. The results, compounded over decades, are. You already know which one to start with. Now, start.